Everybody is hoping for an easy fix to the home affordability problem in the United States, but the solution isn't as simple as most people think. Let me show you. If we go back to the year 2021 and you wanted to buy this home, let's assume that this home costed $500,000. Now, if you put 20% down to purchase this home, which a lot of people did not do, but let's assume you put 20% down, that would mean you put down $100,000 as a down payment and you finance the other $400,000. Now, if you remember back in 2021, mortgage rates were a whole lot cheaper. So you might have been able to get a 30-year fixed rate mortgage for 3.5%, which means that your monthly payment on this $500,000 home would be just under $1,800 a month. Now, if you wanted to buy this exact same home in September of 2023, the first thing is you're not going to get this home for $500,000. Actually, according to Fortune magazine, they say that home prices have grown by around 40% in just the last 2 years. That would mean that this $500,000 home back in 2021 would cost $700,000 now in 2023. Now, if you want to follow the same numbers, that would mean you'd put down the same 20%, which now is not $100,000. This is $140,000 you have to put down for your down payment, and you can't get a 3.5% mortgage. Now you're going to be paying 7.5% for a 30-year fixed rate mortgage. If we stick with the 7% number, you get a 7%. 30-year fixed rate mortgage. Now you're not financing $400,000 like you were here. You're going to be financing $560,000, which means your monthly payment is now going to grow to $3,700 a month. Actually, a little bit higher than $3,700 a month, but we rounded it down for this example. This is where things start to get interesting because what you see is that the price of the home grew by 40%. Your down payment amount grew by 40%. But now your monthly payment from $1,800 a month to $3,700 a month for this exact same home has grown by over 105%. Now, if you really want to understand why this is so important, you have to take a look at the growth in the cost to buy a home relative to the growth in people's wages. Because if your wages have grown by 105% in the last couple of years, then no big deal, because now your 105% wage growth will cover this growth in monthly mortgage costs. But if you take a look at the Bureau of Labor Statistics, what you'll see is that wages and salaries grew by around 4.6% from June 2022 to June 2023, and they grew by another 5.3% from June 2021 to June 2022. So let's round the numbers out to make it a little bit easier to digest. Wages between 2021 to 2023 have gone up by right around 10%. This is according to the Bureau of Labor Statistics. You can compare that to the growth in home prices, you can compare that to the cost of your down payment, and you can compare that to the cost of your monthly payment, and you can start to see why home affordability is starting to become a problem. Now the question is, how do you solve the home affordability problem? Either you have to increase supply or you have to decrease demand. I mean, you can increase supply by building more homes, because if you build more homes, then maybe the home prices would fall. And if home prices fall, that could mitigate some of this growth in higher home prices. Or you can lower demand, because if there's less demand, then again, home prices could fall, which would make it more affordable for somebody to buy a home. But you also have to remember that if homes become more affordable, that means the people that bought homes at these higher prices could become underwater, because now the value of your asset that you own is now worth less than what you owe on the home. And that could also become a problem. So then the next solution is, well, what if we start cutting interest rates? Wouldn't that make it easier? What if we go back to a 3 or 3.5% mortgage? Then people could afford buying a home again. Now, let me start by talking about who thinks we're going to see mortgage rates fall and where mortgage rates are going. And then I'm going to talk about the impact of lower mortgage rates, because what we're seeing right now is there's a lot of entities out there that are talking about how mortgage rates are about to fall essentially tomorrow. This is a chart published in August of 2023 by US News, and they're taking a look at mortgage rate predictions by Fannie Mae, Wells Fargo, and the Mortgage Bankers Association. And what you can see is that all three, Fannie Mae, Wells Fargo, and the Mortgage Bankers Association, are predicting a pretty steep decline in mortgage rates starting the third quarter of 2023, which is essentially right now, through the fourth quarter of 2024, meaning through the end of next year. And the green line, which is the Mortgage Bankers Association, is expecting the biggest drop between now and the end of 2023. But it's not just banks and lenders that are predicting predicting a steep drop in mortgage rates. The National Association of Realtors also keeps talking about how they're predicting a drop in mortgage rates very soon. Now you have to remember why these entities, why mortgage bankers, lenders, and realtors are talking about a drop in mortgage rates, because they get paid on commission when somebody buys or sells a home. And what we know is that when mortgage rates are lower, more people are willing to buy their home and more people are willing to sell their home, because then, well, when you sell a home and you have to go out and get a 7 or 7.5% mortgage, when you locked in a 3.5% mortgage, you're less likely to sell. So when mortgage rates go down, more people are likely to sell, more people are likely to buy, which means bankers and realtors make bigger commissions. So you have to understand why they want to see mortgage rates fall. But the reality is, what causes mortgage rates to fall? Now, there's a number of different factors that influence mortgage rates, but the one factor that we're going to focus on is the Federal Reserve Bank. Because what we know is that the Federal Reserve Bank has been working to increase interest rates, not your mortgage rate, but the interest rates that banks pay to one another. Think of it like the wholesale price that banks have to pay to borrow money at. That's what the Federal Reserve Bank controls. The Federal Reserve Bank has been increasing this baseline interest rate over the last year and a half or so. And the reason why they are increasing interest rates is because this is how they fight inflation. They've been increasing interest rates, making borrowing money more expensive to bring inflation down. Now, you have a lot of people hoping and praying and saying that interest rates are going to fall, meaning mortgage rates are going to fall. Well, in the most recent inflation report that came out in the end of August, what it said is that inflation is actually creeping up a little bit higher. Now, we've been kind of seeing the trends of this happen because we're still seeing such strong consumer spending and consumer demand. And the Federal Reserve Bank has been working to increase interest rates to decrease demand and decrease spending. Because when you make interest rates more expensive, it makes people less likely to go out and spend money. Because if you have to go out and pay more money to borrow your money, you're going to be a little bit less incentivized to go out and actually spend your money because, well, it's going to cost you more money. But what we're seeing happen is that this inflation fight is more difficult than the Federal Reserve Bank originally thought, and this poses the question: will the Federal Reserve Bank continue raising interest rates to bring inflation down, or are they going to keep interest rates where they are? Now, you have some entities saying, oh, the Federal Reserve Bank is just going to start cutting interest rates. But remember, the Federal Reserve Bank has been raising interest rates to bring inflation down. The last inflation report said that inflation went up. So what will the Federal Reserve Bank do? Well, nobody can predict what the Federal Reserve Bank does, but this is where it's important for you to understand what influences interest rates, because if the Federal Reserve Bank stays aggressive on their interest rates and they potentially keep raising interest rates, that will put more upward pressure on mortgage rates. Which brings me to the question of what happens if the Federal Reserve Bank did cut interest rates? Will that make buying a home more affordable? Now, we've been covering all of this in Market Briefs. Market Briefs is my free financial newsletter. If you have not joined Market Briefs, it's a free and easy way for you to stay up to date on what's happening in things like the housing market, the stock market, the economy, the global economy, and the crypto market. It's a fun and easy to read email. You can read it in less than 5 minutes every morning, and it's completely free. So if you have not joined Market Briefs yet, I got the link for you down in the description below, or you can go to briefs.co/market. That's briefs.co/market. Now let's think about this for a second. If tomorrow mortgage rates went from 7% to 3.5%, what would happen? Well, what would happen is you'd have all these buyers or people who want to buy a home that are sitting on the sidelines flood into the market and start buying a home again, or try to buy a home. And if you remember what was going on 12 to 24 months ago, we were seeing bidding wars everywhere. You had all these people that wanted to buy a home and these many people that wanted to sell it. And when you have so many people that want to buy a home compared to the few people that want to sell it, now the people that want to buy a home are going to be putting all these offers to the few people that want to sell it, and now you have bidding wars. Now you go and list your home for sale for $500,000. In the first weekend, you get 24 offers, and people are willing to pay you $600,000 for this $500,000 home, and then this pushes home prices up. Why? Because when you're a seller and you list your home for $500,000 and somebody offers you $600,000, you're not going to say, oh, you know what? You keep that extra $100,000 in your pocket, just give me $500,000 and we'll call it even. No, you're going to want every penny that you can get. So you're going to sell your home for $600,000, then your neighbor's going to say, oh wow, you made $600,000 for selling your home? Maybe I should sell my home for $600,000. And now you can start to see home prices slowly start to trickle upwards, or even not slowly, sometimes it can be quickly. But then the problem is, if home prices are growing, what does that do to the inflation problem? Because if you remember, our inflation report is made up of many different parts of the economy. But one of the biggest parts of our inflation readings is the housing market. In fact, it makes up close to 40% of our entire CPI number. CPI meaning the Consumer Price Index, that's one of the measures of inflation. And so if the housing market indirectly or directly makes up about 40% of the total inflation number, and the Federal Reserve Bank has been working to increase interest rates to bring inflation down, well, if they cut interest rates and mortgage rates fell, where's inflation going to go? Inflation would shoot back up because now you're going to see the bidding wars happen again, you're going to see home prices rise very quickly again, and that's going to put more upward pressure on the inflation problem, which then would mean that the Federal Reserve Bank would have to start the same cycle all over again to keep increasing interest rates. So you can start to see the dilemma. Now the question is, how do you solve this problem? Now again, home prices are determined by supply and demand, period. When you have more buyers than sellers, more demand than supply, that pushes home prices up. When you have more sellers than buyers, that pushes home prices down because now the sellers are competing against each other by cutting their prices. Now what we're seeing happen today is we have a very low amount of supply. We have a very low amount of sellers. At the same time, we have less buyers because interest rates have gone up so much, but buyers are still there more than sellers. And so this is where the Federal Reserve Bank can work on the demand side. They're working to cool down demand, trying to equalize demand and supply. But we also need more supply. But the question is, how do you get more supply? You can do it voluntarily or involuntarily. The voluntary way is builders go out and they build more homes or they build more apartment complexes. The involuntary way is you get more foreclosures. Now, we're not seeing more foreclosures happen because people have equity in their homes. And so if you run into a financial hardship, instead of going out and going into foreclosure, you can just sell the home and walk away with some cash. But on the voluntary side, with builders are kind of facing this dilemma of, should I go out and build another home and risk potential pain in the economy next year and risk potential higher interest rates next year and have to deal with the potential volatility and not be able to sell my home because builders take on risk to build a neighborhood, to build an apartment complex. And so you're seeing builders build homes, but they're building them with caution because they don't know where the economy is going to be in 12 to 18 months because it takes time to build a home and builders have to take on the risk to build a home, which then means, well, we have to look at demand. How do you cool down demand? You got to raise interest rates. And if you raise interest rates, it becomes more expensive to buy a home. But if demand goes down because people can't afford homes, then sellers would be forced to cut the prices of their homes because if they list their home now for $700,000 and nobody goes out and makes an offer, then they might be forced to cut the price of their home to $675,000, $650,000 until they can find a buyer who is willing to pay that price for their home. But the Federal Reserve Bank does not want to see home prices fall. Instead, what they want to see happen is they want to see home prices grow at a more steady and slow rate, because when you have home prices and home costs growing way faster than wages, well, that prices out people, but people are still willing to pay today. So when it comes to understanding home affordability, it's not just home prices. You got to also take a look at the mortgage costs, and you got to compare this to how much incomes have grown. And to really understand where home prices are going, you have to understand the demand side and the supply side. And this is what we're keeping you posted on in Market Briefs. When I first started learning about entrepreneurship and I first started seeing success in entrepreneurship, this is years ago now, I was so obsessed and I was so excited because I finally, for the first time, started making decent money. And if you want to quantify decent money, it was probably $200,000 or $300,000 a year as an entrepreneur from my own